Welcome to the daily update, where I'll go over the action in the market for Wednesday, March 19th, and we'll see how things look for Thursday, March 20th. Okay, we're seeing some improvements here. Now, a solid down day could wipe all of those out, and we're really not seeing much of an improvement with our growth to value ratios. Value's still holding up better right now, meaning that the market is getting more defensive, but we're seeing price going up. We're seeing some of our indicators show some improvement. We're still negative in the short and intermediate term. So we'll just see. Can the market build on this? There was fairly positive reaction to the lack of doing anything with interest rates as far as the FOMC is concerned, but the market took it more as positive with what Chairperson Powell said during the press conference, even though the Fed did make some adjustments to their overall forecast for what's happening. So, right at the open, we did have a higher open, but then right after the open, we shot down and we found support at the daily pivot at 56.22. Then from there, we climbed back up to R1 at 56.47. Then we just kind of settled down. Now, there's a little more movement than what we had seen in the past before the Fed makes an announcement, but the market knew that interest rates were not going to be changed. So we just kind of went above and below R1 in kind of a slow rolling fashion. And then after the announcement, prices rose up above R1 again. So we had fallen down below that. We got above R2 at 56.79, and we even got above 5,700. But then we fell back down below 5,700 and closed slightly below R2. By the time we were done, we were up 1.08% on below average volume still. And we are still negative in the short and intermediate term because we're below the 20 and 50-day moving averages. We're mixed in the long term. Interest rates fell down a little bit, and there's a little bit of an increase in inflation as far as the Fed is concerned. And I'll go through that in just a moment. Some comments. Rates were left unchanged at 4.25 to 4.5, and that was as expected. So no surprises there. Mega caps had a pretty good day, and that's what helped the market to go higher. It seems like one day they do well, and we're seeing hope in that area, and then the next day they don't do so well. The VIX is back under 20 now. That could be considered positive. We're still coming in at 19, just under 20 at 19.9, but the fact that we're under 20 is more positive. And this is negative though. The S&P 600 small cap index that we follow, it's now generated a death cross, meaning that the 50-day moving average has now crossed below the 200-day moving average, and I'll show that chart later. In the short term, we're still looking rather extreme, but we're seeing a weakening trend with the ADX. I'll go through that chart as well. In the short term, we've already crossed below the moving average. So we're still in a negative trend, but it is rolling over and suggesting that that short-term basis trend anyway is now weakening. And we're starting to roll over a little bit in the intermediate term. We still have the Stochc RSI, which is back on the list now after the up move. The stochastics, which never went off the list, and then the rate of change going back 20 periods, as well as the slope oscillator. And then in the intermediate term, we just have the TTM squeeze right now. And even that's improving. It's actually coming up and looking a little more positive, but it's still giving us an extreme negative reading. We still have this non-confirmed Hindenburg omen. No changes. I thought there would be a change to the overall scenario, but what the Fed is doing is just leaving rates where they're at right now. We're still hanging on the side of a possible soft landing, meaning we won't go into a recession, but that's likely to change at some point if we see weaker than expected economic reports continue to come out. And the Fed has also increased its inflation outlook. Now, they did that before and they did it again at this meeting as well. And they've also lowered their growth expectations. The dollar was up and interest rates were down. We were at 4.26% with the 10-year yield, where we had been at 4.28%. We're still extreme negative as far as sentiment. We're below that 25 level. we ticked up to 22 where we had been at 20. And we're still inverted with the 10 to the 3-month yield curve. We were even after yesterday's session. We're back to being inverted now. And we are still negative with the trend. Now, the ADX, it's still above the moving average. The one that I base this on is the intermediate term chart. What I was talking about up here is the short term chart. We are rolling over a bit, but we're still above the moving average. That suggests a strengthening trend, and it's negative because the red line is above the green line. With the up day, our bias is positive, and now I'm changing our momentum back over to mixed. Now, of all the things that I go through in the videos, I try to let the charts speak for themselves, both the positive and negative. These two things I come up with pretty much on my own. The bias, usually, was it an up day? Was it a fairly positive day? Then I would put positive in here. And then I look at the last number of days together to come up with the momentum. And right now I'm mixed to slightly positive, but we have another down day. This could easily go back to negative. All right, so this is an additional section that I'll go through just to kind of go over the different areas that happen in the Fed meeting. So there's one of the Fed governors named Waller. He disagreed with the pace of the balance sheet reduction. Didn't everybody voted to keep rates the same? That didn't change. But then they discuss, okay, what happened when we had the COVID lockdowns? The Fed came in and started just buying bonds like crazy. Crazy, crazy, crazy. Well, then in June or so of 2022, the Fed announced we're going to stop doing that. And in fact, we're not going to buy anymore. That's a form of quantitative easing, something that, of course, the Fed said they would never do. But now that they've done it, it's expected that if we run into economic difficulties, the Fed will come in and actually start to buy bonds. Well, as those bonds mature, they just let them fall off the balance sheet. And they made an announcement at that time that they're going to let so much fall off at any given time. He didn't like the current pace. Okay. He wanted to maintain the current level of the runoff, but was overruled as the committee decided to slow the monthly roll off. So they had been decreasing 25 billion a month. Now they're going to lower that to 5 billion a month. And that's going to start in April. Now another thing that they also are participants in are mortgage-backed securities, which if you ever saw the movie The Big Short, that kind of had a big deal in that movie. This is unchanged. They're still letting 35 billion each month run off in that. Then the directive, it also acknowledged rising economic uncertainty, and a lot of that's pretty much due to the tariffs, while maintaining that the Fed remains attentive to both sides of its dual mandate. Now, if you're not familiar with the Fed, when the Fed was created 112 years ago, I think it was, back about the same time we had to start paying income tax and under Woodrow Wilson, they were like their mission statement. It says you have two things that you have to do as the Fed. Maximize employment, so set up an environment so that anyone who wants to have a job can have a job and keep prices stable. Okay, well, they really haven't done that, but they're trying. Okay. And there's a lot of people that think the Fed should be done away with, that they shouldn't exist. There's other people that think it adds stability to the US economy, and that since the Fed was set up, the US economy has, or the US itself, based around its economy, has become the world power, superpower, and then shared that with the Soviet Union for a while, and now China and so forth. And then another mandate that they've come up with too is that they want to keep inflation at 2% or below and moderate long-term interest rates just to try to keep things under control. Now, the Fed was around in the mid to late 70s when I was growing up. That didn't happen. But how they got things under control, at least one way, was by coming in and just keep raising rates until finally they started to top out and then come down. So this isn't part of what happened in the meeting. I have it in italics here just to give a little bit of a definition if you're not real familiar with what the Fed actually is supposed to do. Then they come out with this new report, and I say new because it's relatively recent when they started releasing this. It's the Summary of Economic Projections, or SEP. I guess you could call that septic tank. I don't know. And the Fed lowered its 2025 GDP growth forecast. Now, if you remember in some of the other videos, that the GDP now from the Atlanta Fed, they're actually suggesting negative GDP. That's their forecast, where the New York Fed is still positive. They're around 2.6%. Well, the Fed itself has come out and said, okay, we thought GDP would come in at 2.1%. We're going to lower that to 1.7%. Still positive, though, but it is going down, suggesting that they're concerned about economic growth. And then whilst at the same time raising its PCE inflation. You remember when we get the PCE report and the core PCE? The core PCE, which the last time we had that report, it went up to 2.8%. Well, they've raised their inflation outlook from 2.5% to 2.7%. So, in spite of all that, there's still anticipated that rates will be at 3.9%. Well, they're at 4.25 to 4.5 now. That means that there'll be at least two rate cuts still this year. That's being figured into the system right now. Then the modifications, meaning weaker growth and higher inflation forecasts and the rate cut projections, indicates concern mainly with this inflation that just they call it sticky inflation or stubborn inflation, where some areas of the economy, the inflation is just not coming down at this point, and that's keeping rates above this 2% target level. So then after that, and after they made their announcement and the SEP came out and all of that, Chairperson Powell had his press conference and he said again, we're not in any rush to adjust what we're doing right now. He warned that it is going to be very difficult to have a precise assessment of how much inflation is coming from tariffs. And that's why there's all these projections that come out, and they're all over the place because nobody really knows what kind of an impact that's going to be. And in fact, in this press conference, Jerome Powell used the word uncertainty a whole lot. And that's not a really good thing when you have the leader of the Federal Reserve saying, we're not sure, we don't know, we're uncertain. So it's not real comforting in that regard. Then he indicated that it's kind of the base case that inflationary pressures from tariffs would be, oh, here we go again, transitory. Excuse me, transitory. You remember when we heard that word before? This was after the whole COVID plunge and interest rates were starting to go back up, and everybody just said transitory, transitory, meaning they're just going to last for a little while things are transitioning over to something else. Well, that pretty much blew up in their faces, anybody who said that. And transitory became more permanent. And now that's why we're trying to deal with this inflation. So there's going to be a lot of folks that anytime the word transitory comes out of the Fed again, they're going to be gun shy. It's like, okay, you said that last time, and that's not what ended up being. So adding that the last time tariffs were imposed, the increase in prices was transitory. Well, it happened the way that last time. Now, this was before the COVID lockdown, before all the stimulus, before the policy changes and everything that happened during the whole COVID era, I guess, because nothing like that had ever happened before. And so they unleashed all this liquidity into the market, which helped the stock market, but it also unleashed inflation that we're still dealing with now. The other time that this happened was back in President Trump's first term when he imposed tariffs at that time and just said, okay, there was inflation that came in, but then it went away after a while. All right, and then this is put out by Edward Yardeni, and the blue line is what we're focused on right here. This is the current year Fed funds rate forecast, where we're at 4.25, right about where I have the red cursor here. That's where we're at right now. And they project it to be down by the end of the year. That means there's rate cuts that are involved with this. Okay, so the economic reports that came out, just the weekly MBA mortgage applications index, and it was down 6.2%. Last week it was up 11.2%. All right, and here's a look at this. And this is not that impactful as far as the market. I follow this mainly because what's going on in the economy, and you can get a good gauge on what's happening in the real estate area of the economy by how many mortgages, either initial mortgages or refinance mortgages, are actually happening. And we were down in the latest reading here. All right, then the annual change in earnings is the best indicator. This is a long-term chart, and this goes to what I say constantly. It's ultimately earnings that drive stock prices. If earnings are going up, stock prices will go up too, either on a company by company basis or looking at the stock market as a whole. Well, we're coming down now a little bit here as we've been seeing this, and this is what I've been mentioning that the earnings are looking positive going forward, but not as positive. The forecasts are actually coming down. So they're still looking okay, but they're dropping from where they were. And this is what the stock market uses to evaluate things. And we're also going down with the year over year change here, not only with the S&P that's dropping, but also with the earnings as well. And this is different than what we've seen back over the last few years. In 2023 and in 2024, Mondays and Fridays were the best days. Well, so far in 2025, Monday is the worst day. And that it always had that kind of reputation. That there was a book I read years ago. It's called Don't Buy on Mondays because it seemed like Mondays were not very good days. They were usually down days. And but we saw things go against that over the last couple of years where Monday was one of the better days. And now it's turning back into one of the bad days again. All right, then looking at the truck tonnage index, this is another gauge of the economy. The purple line is the S&P, which has been coming down. We're pretty much sideways here with the truck tonnage index, even though they had kind of skimmered along with each other here. We've seen a real disconnect between the two, and they've been going sideways as the market's been going up. You could call that a negative divergence, but in the latest reading, this is starting to go back up, but it's been very range bound. This is another look at PE ratios and valuations, and it's just comparing the different indexes here in the US. The one that we focus on is the S&P, and we're right around 20, and we're just a little bit above that. And we still use that 10, 15, 20 scale. When we're at 20 or above, the market is considered expensive, and this is NTM, the next 12 months. So this is looking out into the future. And then I go over this every weekend, excuse me, in the intermarket analysis video, because we don't use this to make decisions, but we just want to know the basic context of what's the market like right now. And it's expensive and has been expensive for quite some time. And even with the declines that we're seeing, it's still considered to be expensive. And this also shows the quarterly earnings per share consensus. This is really starting to come down. So they're being cut. And this is what's been really, at least when we were going up earlier in the year, that's why we were really slowing down. And the declines that we've seen lately, some of that can be attributed to earnings projections actually being lowered. Then corrections and recessions. 44% have crossed over with each other within a year. 66 haven't. Okay, it's just we had a 10% correction as of last week. A week ago, the S&P was down 10%. That's considered to be a correction. So, did a recession start within the past 12 months? 12% of the time. Well, how about looking forward the next 12 months? 32% of the time. No recession within 12 months, 56% of the time. So just to say that we went down 10% doesn't necessarily mean, in fact, it almost means the opposite, that there's not necessarily going to be a recession going forward. The economic surprise index, we're still getting readings below zero here. And that means that the reports that are coming out are weaker than expected. And that's the market likes that. It depends on the context. Right now, bad news is seen as bad news, and lately, good news is being seen as bad news. At some point, the market will say, okay, the weaker than expected, we like that because maybe the Fed's going to change their mind and actually come in and cut rates. And now we see it as a good thing. Where right now, the weaker than expected economic reports are producing these growth concerns about the economy. And so bad news is being treated as bad news. But then lately, good news has been treated as bad news too. All right, then where are the positioning right now? Now, this is more systematic. This is where you just apply a system. You don't care about whether the market's up or down, whether we're positive or negative. You just put your money into a system and it's actually showing negative returns now. And then this is looking at the pre-owned housing units and then building permits, which come out. We're just kind of chopping around here. And a lot of times when we top out and then start to go down, that is usually indicative of right before we go into a recession. They have a red arrow here. And but we've been kind of going sideways right now. This was the recession, this was the COVID crash and then the ultimate recession, but we've been pretty much chopping sideways with this lately. All right, then a couple interesting charts here. Predictions frequently miss the mark. You think? Everybody loves predictions. It's like, why do they even put the weather in the news? I mean, there's just as much of a chance of them being wrong as they're being right. But it's even more difficult if you turn on the news and they say, yeah, here it is, the middle of March, and but just wait. In August on the 17th in the afternoon, it's going to be sunny. I mean, how do you know? I mean, chances are it will be because that's summertime, but it could be raining. There could be, there probably won't be snow, but everybody likes that. That's why, like with the videos I do, I don't get as many views. I don't have as many subscribers on my channels and things like that because I don't forecast. I just evaluate things and say, okay, this is what it looks like right now. The probabilities are that we could go up, we could go down, what have you. But people still love forecasts anyway. Even if they're wrong, they still want to say, this is what I think is going to happen. And a lot of the comments that I get are, well, I think this, I think that. And then, 16 months from now, this is going to happen. Fine, do all your forecasting. But I just I don't do that. But even and these are the professionals down here. They're supposed to really know what's going on, but even they get it wrong. Okay, markets are still pricing in strong U.S. growth. Okay, we're still up around here, even though this is projected to go up and then come back down. It's still looking fairly good, at least looking at GDP this way. And then on this next page, it's a double digit down year nearly always has a negative catalyst. Okay. Well, we don't know if that's what's going to happen. But yeah, there were some kind of big things that happened that had an impact on the market, like the Great Depression, you think. World War II, yeah, that might have a little bit of an impact. Recessions that have happened, not only here in the 50s, but big ones in the 70s. This is the gas crisis and all that. And then the tech bubble, that was the dot-com boom and bust, the financial crisis. Fed policy mistake. Oh, isn't that interesting? And inflation crisis. This is where they said it's transitory. And then it ended up being more than that. Okay. So, but we don't know if we're going to have, this is March. We got 9 months to go. All right. So then here is a look at some of the forecasts here. We're looking at over 7,000 to the upside if you're a perma bull. And then we're looking at under 50, about 5,500, which is a couple hundred points below where we're at now, to the downside. Take your pick. Just throw darts and see what you come up with. All right, so here's the chart. And we did have a little higher open, but we dipped down here, but we found immediate support right at the daily pivot. And then we came up, got above R1, and then we just kind of went up above R1, then down below, then above, down, down, down below as things settled down a little bit. And then the Fed made their announcement. It was taken as positive. Then we more clearly went back above R1. We got above R2. We got above 5,700. But then as we were going into the close, we did give back a number of those gains, and we closed just a little bit below R2. And we're up again here. We're up, I think it was about 0.3, 0.4% in the initial overnight session, but this is many hours before the market opens. But things were pretty quiet because it was Fed day and people don't want to take on big positions before something could happen. There's too big of a variable with what they could say. We're not seeing much of an improvement here other than both charts are going up, but the red line is still above the blue line when we look at growth to value intraday. Not much of an improvement here either, although we are going up slightly here with the S&P growth to value ratio. On the end of day charts, the growth was up 1.47%, value was up, but only up a little over 0.5%, where growth was up more for the mid caps and the small caps. But we're just not seeing much of a change in our growth to value ratios with the small caps, which have now gone into, at least the way I measure it, a death cross, a downtrend. But their growth to value ratios are not looking all that good, nor are they looking all that great with the mid caps and even the S&P growth to value ratio. It's just not showing any real improvement, at least yet. We're not seeing really any improvement here with the growth to value ratio between these two ETFs. Not seeing much of an improvement. I mean, a little bit, but when you look at discretionary versus staples, no, we're not really bouncing back there. And this is the intermediate term trend where we're rolling over with the ADX, but we're still above the moving average. We're still negative though. The red line has been coming down, the green line's coming up. This won't roll over positive unless or until the green line crosses above the red line. Now, in the short term, we're already crossed below the moving average. So this suggests the trend could be weakening. It still means the trend could be rather ferocious. It just means that it's likely closer to becoming near the end of it than it is at the beginning of it, like when it was way down here. All right, and then we're still below average with volume. And then I kind of started adding this new chart here. It's really hard to see, but it's red. That just means we were below average with the volume for the S&P. And then this will come out probably in Friday's video. And then I've been in, no, it'll come out over the weekend. I changed this. Investors Intelligence. And they were giving a really negative reading last week. Well, it's pumped up a little bit here, but it's still pretty negative overall, which could end up being positive for the market. Still getting a very high reading with the ulcer index. A lot of fear in that fear gauge, but we're coming down and dropping below 20 with the VIX on a closing basis. Also dropping down below with the bar chart. That's the open, high, low, close. Excuse me. And we're dropping here with the VIX of the VIX. That's dropping a little bit faster than the VIX right now, which could end up being positive. And we're going down with the momentum. You can see it by just looking at the chart. The VIX is going down and the MACD is picking that up. And we're going down with this fear gauge, but we're ticking back up virtually unchanged with this other fear gauge, but up slightly. And we're going down with the equity put call ratio daily chart. We're going down again now with the 5-day chart and barely down here with the 10-day chart. And also dropping with the volatility risk premium. That continues to show a lack of fear looking out over the next 30 days, as do all of these other, the VIX and the other gauges that we look at. Now, the advanced decline line still holding up fairly well here based on price, kind of going along sideways, seeing a little bit more of an improvement here based on volume. And we're actually crossing back above zero with the advanced decline over the last 10 days. When it's above zero, that's considered positive, even though it was flat to slightly down here. And we're seeing some improvement here. More new highs than new lows, kind of flattening out with both. But it's enough of the new highs to turn us back up with the 5-day chart, and the 10-day chart is starting to level off after declining. We're positive here with the advanced decline ratio in the short term, coming back up and showing some improvement with the intermediate term. We're positive with accumulation distribution. We're just barely above the moving average, but we're still above it, so that's positive. But we're negative with the Chaikin money flow. We continue to decline, and the red line's going down, and we're kind of just chopping around here. We're still going down with the Chaikin oscillator. So, despite the upward move, two of our three smart money indicators continue to be negative. And we're coming down here with the vortex. The red line's coming down as the green line's going up, but we're still negative. So this is improving, possibly. And we're seeing a little bit of an improvement, but we're still negative here with the stocks inside the S&P above their 20-period moving averages. Bit of an improvement with the 50, 100, and 200 period moving average studies, but they're all still negative since they're below 50. And we're back above the moving average again here, and turning up a little bit with the S&P. This is a different moving average than on the previous charts. This is still one of the better looking indexes. We are improving with the NYC common stock, but still below the moving average. And the same is true with the mid caps and the small caps. And we're still underneath the 200-day moving average. That's going to be rather significant. The longer we stay below the 200-day moving average, the more resistance it's likely to provide if we go back up there and we continue to be below average with volume. So a little bit of an improvement with the 20, 50, and 200 period moving average study here. We're starting to get extreme. This is showing good positive momentum, at least as far as the Stochk RSI is concerned. But we're showing some improvement, but still below the midpoint with the Williams percent R, and still below the midpoint with the CCI 14 and the CCI 20. And we're going back up a little bit here with the short-term stochastic and intermediate short-term stochastic. We're still extreme negative with the long short-term stochastic. Still negative with the force index, but it's improving. And we have the rate of change going back 20 periods, still extreme negative down here below this pink line. And the condition of the short-term trend improving, but still negative. We're in the -2 channel with our standard deviations chart. Actually, I take that back. We're in the -1 channel here. So that's showing some improvement there. And showing some improvement with the balance of power, with an actual possibility of it crossing above the midpoint and turning positive. And we're still the lighter shade of purple here with the go, no go. So it's negative, but improving. And bouncing off of the lowest low value, that's showing some improvement. The TTM squeeze, you could almost make a case for this being positive because it's going up and it's the lighter shade of red, but it's still below this black line, which I put on here just to kind of give a little guide as to are we getting extreme negative, which we're still at that point. And we're really coming down here. We with the standard deviation. We've been moving very quickly. Now we're starting, at least for right now, it looks like we're trying to go back up. And so that's making the standard deviation come down because it's figuring in downward moves and upward moves into its calculation. Improving, but still negative with the ease of movement, still negative and below zero here with the Arun indicator. It's positive with the McClellan oscillator for the S&P, above zero and advancing. So we're going up based on price with the summation index and based on volume. And above zero with the NYC McClellan oscillator. So we're turning back up slightly here with the summation index for the NYSE based on price and volume. Above zero and advancing with the Swanland Trading Oscillator, both based on price and volume. And turning up, it's still negative after getting extreme with the PMO, trying to turn back up based on price and volume. Now, what we see quite often is these two breakouts, price and volume, they tend to move quicker than the overall oscillator itself. So if these start to cross positive, and we're getting really close here based on volume, that could probably happen before we see it with the actual indicator. Seeing an improvement here with the PMOs that are rising, as well as the buy signals, and we're flat with the PMOs that are above zero. The condition of the intermediate term trend improving, but now we're just getting back up to the red line. We need to cross back above both of these lines and stay above them to turn the lines back up. And we're still below all the moving averages here. We got a little bit above the 200-day exponential moving average, but we closed down below it. That's still acting as overhead resistance with the exponential. The big one's going to be the simple moving average if we get to that point. And we're still seeing a little bit of overhead resistance, at least on a closing basis with our anchored moving averages here. We got a little bit above the blue, but then we closed down below it. And this is tied back to the low that was set a year ago. We're still neutral with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. We're turning back more positive after being extreme negative with the slope oscillator. We're still extreme. It's going to take a while just to get back up to this red line. And the MACD is improving, but still negative. So looking at our oscillators, we're starting to turn positive in the short term on a momentum basis. We're improving, but still negative in the intermediate term. We're still negative in the long term. And the Copic curve starting to cross above the red line. That's showing an improvement there. And we're no longer extreme negative with the Sean trend meter. It's improving. And we're improving here with the money flow, but still below 50, where the ultimate oscillator is just barely crossing back above 50. So that's actually turning positive. We're still below the moving average with unbalanced volume. It'll be more positive if we can get back above that. And improving, but still below 50 with the RSI of 14 and 9. And the bullish percent index continues to improve. It's above the moving average and going up. That's actually positive. And we're going up with the NYSE bullish percent index and the NASDAQ 100 bullish percent index. Still wondering if we're going to get a signal here. It won't be a signal until we get down to the red dashed line. It's trying to signal a reversal, which in this case would be going up because we have to look at the context. Now, if this signal is triggered and then we don't see anything for a while, the further we get away from a signal that is generated, the more irrelevant it becomes. All right, then we're still dealing with this 61.8% retracement level here with the Fibonacci chart. We need to get above that and close above it. And that would also get us back above 5,700. We're still holding up though with support. Long-term chart here, we're above this pivot point. And we're showing some improvement here with a trend based on the Heiken Ashi chart. The Keiki chart's actually positive. It's black and pointing up. We're negative with the Renko chart and we're negative with the three-line break. So we're not seeing the same thing with all of our charts. Long-term, an improvement with our 150 and 200 period moving averages. Still, this just doesn't seem to change. Still negative in the short and intermediate term with all the different stock indexes. And then we've gone back to positive with commodities in the short term, and they're positive across the board. And this is producing some of the inflationary concerns because these are things like corn and wheat and different things that you would have to pay more for if they cost more in the commodities market. And the dollar is still negative in the short and intermediate term. All the sectors ended up being positive. The least positive were staples, and that was unchanged, where we had discretionary, tech, and communication. Those are growth areas. We need to see follow through with this. We need more of this if we're going to turn back and be more positive with things. And then an awful lot of green or blue here. But Canada, hey, good for you. You had a bullish MACD crossover. We also had a bullish MACD crossover with the industrial sector. And then we had the NASDAQ going above 17.6, 17.7, 17.8, 17.9. The only negative thing, which could end up being positive, is we had a BPI cross with the consumer staples below 50. And that's defensive. And if that's starting to show some weakness, that could be better for growth. And then the S&P did get above 5,700, but then ended up closing down below it. We also are seeing some improvements here with the tech sector, a bullish MACD crossover. The Dow got back above 42,000, but it's still below its 200-day moving average. But then energy, which is usually considered more defensive, that had a BPI cross above 50. And Canada seems to be doing quite well now. And the materials are, after being really extreme negative, are showing some improvement there. And the Dow here, we're right a little bit below the 200-day moving average, even though it was up. And we're still neutral with the diamonds looking at the Elder's Impulse system, improving, but kind of building a possible base here with the NASDAQ above this S2 support level. Same thing with the NASDAQ 100. Still neutral with the NASDAQ 100, looking at the Qs with the Elder's Impulse system. The momentum is improving, but still negative. And here's where we're seeing the blue line cross below the red line. Now, quite often, what will happen is once we see a new trend, we might see a counter move against that. You can see this has been pretty choppy over the last few years, but it is negative. We're not quite there yet with the Russell 2000 small cap index, and they are showing some improvement, coming up a little bit with the RSI, but still below 50. We're actually turning positive with the momentum. And they've turned positive with the Elder's Impulse system when looking at the small caps. And kind of close, but still a little further away with the mid caps. It's also improving, bouncing back above this S2 support level and turning positive with the Elder's Impulse system. And the bank ETF, we actually were able to close above the 200-day moving average. So that's considered positive there. Financial sector improving, but still underneath its 50-day moving average. Still underneath the 200-day moving average with the Wilshire 5000 broad market measure and with the total US stock ETF, but they're all improving. The FANG index is now back above its 200-day moving average, where yesterday it dropped down below it. So we're just kind of dancing along the 200-day moving average these days. Amazon was up, but still below its 200-day moving average. Apple also up, but below its 200-day moving average. Microsoft is in a downtrend below its 200-day moving average. And same thing with Google. It was up 2%, but has a long ways to go. And Meta is still a little bit above its 200-day moving average. Nvidia, we're starting to see a death cross here, and it's below its 200-day moving average. And Tesla really dropping down here below its 200-day moving average. Netflix, probably the best looking chart right now. It's right back to its 50-day moving average. And then looking at overall strengthening to a degree when we look at US versus world stocks, and then a more of a deterioration when we look at the longer term correlation. Oil is going back up into the 70s. That's a little bit inflationary as it's coming back up a little bit higher. And the dollar, it's doing okay. It's still in an uptrend, but it's below its 200-day moving average. And we came down with the 10-year yield, and we were up with the 10-year based on price. We're back to being a little deeper into this red area again with the 10 to the 3-month yield curve. So it's inverted again and seeing really not much improvement. We're not seeing growth to value improvements here. We're still going down with the Qs to S&P, discretionary to S&P, large cap growth to large cap value. Not really seeing much of an improvement with the large caps, mid caps, and small caps. That's a concern. And we are improving here though. And this is another defense versus S&P measurement. The staples, we spiked up right here and now we're starting to come back down. You can see other times that we spiked, usually good things happened after that. But we need to see more follow through with this. All right, so what's our outlook for Thursday? We're still negative in the short and intermediate term, below the 200-day simple moving average. The long-term support is holding, and we are seeing signs of improvement. Some are starting to turn more positive, but we need to see follow through. We have another down day, or 1 or 2 down days, and all this improvement's just going to go flying out the window. But for right now, everything is looking better. And we're going to get jobless claims as well as the Philadelphia Fed Index, existing home sales, and then the LEI, the leading economic index. And then all the geopolitical things. There's talks going on with Russia, Ukraine that the US is involved in, all the tariff stuff going on, executive orders, Doge, Tesla's being lit on fire, painted on and all that stuff. All right, and then we don't have any economic reports scheduled for Friday. And here's a look at what the previous reading was and if there's a forecast here for the reports. Seasonally, we're positive with the Dow and Nasdaq. We're neutral to positive with the S&P for March 20th. We're still dealing with options expiration. So that'll be Friday, and we're up about actually that should be 65% of the time instead of 64. And we see now on our usual basis here, the solid lines, this is positive seasonality for the next few days. But if you look at this with the dashed line, this is the S&P in a post-election year, we might see some weakness. So these two are kind of at odds with each other currently. And we're still in the second half of March, which tends to perform better. Of course, anything can perform better than the first half of March. It wouldn't take much to improve on that. It's a pretty low bar. But this is where we're flattening out right now. We might see things actually break to the upside if we get that far, but it'll be further into the spring. All right, so we're still getting a mixed picture with our smart money indicators, positive with accumulation distribution, but negative with the chicken money flow and oscillator. We're positive with the NASDAQ 100 and NYSE bullish percent indexes. Excuse me, we're negative, negative, negative. We're positive with the S&P. I don't do the same measurements on these, so they are improving. They could probably be positive. The momentum indicators that we look at, we're starting to turn more positive in the short term. The Copic curve is trying to improve, but the long-term special K is still negative. And the moving average studies, even though they're improving, we're still below 50 with all of those. The ease of movement is improving but negative. Money flow still below 50. The vortex improving but negative. And the momentum for the NASDAQ 100 is improving but negative. So positive. Longer term, we still have uptrends when we look at growth to value and discretionary to staples, but we're just not seeing much of an improvement there right now. And the equity put call ratios based on 5 and 10 days are going down, and that's more positive. That means there's less hedging going on, means that folks are more optimistic about the market right now. And the S&P and NYC McClellan oscillators and summation indexes are positive. Parabolic SAR is positive, as is the bullish percent index. And then the financial sector is still in an uptrend, and the banks are finally back above their 200-day simple moving average. And then the Swelling trending oscillator continues to go up based on price and volume. The ultimate oscillator is just crossed over. It's a new addition to the positive side here. Our conclusion, we are negative in the short and intermediate term as measured by the moving averages, mixed in the long term, but still defaulting to positive there, and we're seeing some improvements. I mean, they're not possible improvements, they are improvements, but can we see follow through, more of them developing and actually turn over and look more positive? So we're slightly oversold, but really working that off and actually becoming a little bit overbought now in the short term, where we're just a little bit, just the TTM squeeze is the only thing that is extreme negative in the intermediate term. And we're still positive in the long term, excuse me, but we remain below the 200-day simple moving average. Thank you. I really hope you found this helpful. Have you a great day. It's either I think the first day of spring, and I will talk to you in the next video.